The Federal Reserve raised interest rates by a quarter percentage point Wednesday, the second such increase in 3 months. And that means Americans with a mortgage payment or credit card debt will end up paying much more. And here to help us break it all down is Myles Uland, a markets reporter for Yahoo Finance. Myles, good to see you.
Thanks for having me.
So tell us, what does this mean for people with a mortgage and also with a lot of debt?
Yeah, certainly. So if you have a mortgage, we've seen refinancing spike in recent years as the overall mortgage rate has come down. Now it looks set that we'll see a reversal. We'll see mortgage rates begin to rise. Not that many people anymore have adjustable rate mortgages, so it's unlikely that your monthly payment will increase. But if you haven't locked in a low rate, I think for 30-year was something 4.25%, you are not going to be able to get that rate anymore. It'll be steadily hiking up, which has big implications. A lot of economists will say the housing cycle is basically the economic cycle. So as mortgage rates rise, there's a chance that perhaps the housing market doesn't continue to be quite as strong as we've seen it in recent years.
What type of impact will it have on jobs and also when it comes to companies' hiring practices, the influence?
Yeah, so I think there's another way to read the hike, and I think Chair Yellen would certainly like investors and markets to see it this way, which is that it affirms the strength of the U.S. economy. So to get slightly wonky, the nominal interest rate now is, a little bit under 1%. The real rate adjusted for inflation is still negative. So the Fed would say it's still very accommodative in terms of what they're trying to do to help the economic expansion. We've seen jobs still run 200,000 plus a month over the last year or so. We had 235,000 jobs added in February. So overall, hiring has been strong, and I don't think a 25 basis point rate hike is really going to choke off any hiring we've seen of late.
Now, the Fed was going back and forth whether or not to raise the interest rates. Now we've done it twice in 3 months. Are we ready?
Yeah, I think so. I mean, look, as I was saying before, if we go 2 more times this year, we're just getting to what economists would call a real rate. So this is a rate adjusted for inflation at 0%. Traditionally, interest rate cycles have ended with real rates closer to 3%. So we're, again, looking at an economy that is still kind of feebly recovering from the financial crisis, even though we're a decade past it. And I don't think the Fed really, at this point, is at risk of stopping that recovery. Overall, GDP numbers have still been lackluster. Chair Yellen did make reference to that during her comments today. But I think, really, if we look at where we're at, the unemployment rate, the hiring cycle, I just don't think the Fed is at risk here of kind of choking anything off.
All right, let's talk about student loans. A lot of people will be paying for student loans for the rest of their lives. I knew I sure will be. I want to talk about that. A new analysis of federal student loans reveals that a large number of people are far behind when it comes to keeping up with their payment. It has soared in the past year by 14%. Is the problem just getting worse?
Well, so I found this report very interesting, and I think it kind of speaks to this idea that there are a bunch of people who have been left behind in the economy. So balances didn't really get any smaller. The number of people who are delinquent on their loans increased. But if you kind of look at it, it's people who already had huge student loans who weren't getting jobs, basically feel like they got ripped off taking out these loans, and they decided, you know what, I'm done. I'm not going to pay for these anymore. People who are taking out $5,000, $8,000, $11,000, finishing college and then getting jobs, they are paying those loans off. It's the folks who took out sizable loans, either didn't finish or were underemployed after they finished. They're saying, you know what, I'm just done with this. I'm going to take the hit. I'm going to declare bankruptcy, and I'm just going to, or I guess you really can't declare bankruptcy. They're going to try and move on from these loans.
All right, and the final question for you. As of July 1st, the nation's 3 credit reporting agencies, I should say, said they're going to do away with some bad credit reporting, some things that are on your credit information. What's being excluded, and is this good news for the consumer?
I think so. I mean, they're really just trying to get rid of identity fraud, right? So if there is a sort of negative lien against your credit score, but it is not verified by a Social Security number, that will not count against your credit score. So I think I don't know if there's many people with Myles Uland in America, so I don't have that risk. But if you have John Smith, it's very likely that someone else named John Smith either had a tax lien or was delinquent on some loan, and that's affecting your credit score negatively. The other way to see this is that as we get to the late part of economic expansions, people remember things like the subprime mortgage crisis, and they say, when you start loosening credit standards, you're about to see something bad happen because you're going to have people who can't afford to pay money back be lent money by banks. I don't quite think that's what's happening here. So overall, should be good news. But I do think, at least when this news crossed on Monday, a lot of people were kind of taking this and saying, well, I don't know, it sounds a little bit too much like 04, 05 for me.
All right, Myles Uland, thank you. Good to see you.